Well, hello everyone. I think did we do a video already this year? This might be our second video of the year, but we are now through January. So we made it through January, thank goodness. And now we are here onto February. I will say high level, we're pretty pleased with how the strategies each individually and collectively are holding up. And we are getting through what is, I would say we're in the second of the two biggest earnings weeks of the earnings season this week. And so one of the themes of last week has been that companies that we own did really outstanding earnings numbers and their stocks went down. So we can debate in the long haul whether or not that's important or whether it signals a shift in the tide, but we're not prepared to make that, draw that conclusion just yet. What we can say is a lot of the expectations that went into, the last business quarter of 2020, which is reporting right now, obviously that news was reflected already and had been reflected in the prices of those companies. And so maybe there's just a general pause that refreshes. That's certainly the position we're taking. We went into this year kind of evaluating, the growth value continuum and making, as everybody has seen, and there has been this minimal comments on, sort of shading in that direction, but really haven't made any bold, moves from one to the other. I think it's fair to say we represent, at least in the long view, a very fortress-like balanced approach, ocean liner, whatever metaphor we want to get into. And always, of course, happy to answer direct questions. We will get through in terms of, we have plenty of cash to invest from clients, and many of you new to the firm. And we are letting this week kind of unfold before we see if any of the subplots here in the market kind of start to, get away from us in either direction. So today, of course, I have two very special guests who would be familiar to you all. Jonathan Ting, of course, our Director of Research, and Lauren Moon, who does everything that Jonathan and I and Audrey and everyone else doesn't do. And so she has gotten some calls from people, and I've certainly heard from a couple of as well, about what is happening in the market, what everybody has been talking about, which is the GameStop, AMC, BlackBerry, Nokia, right? These are kind of names that in many of our gadget drawers have been somewhat left for dead, but obviously in the market, there has been a theme where there's a certain group of people that started on a forum on a thing called Reddit, which probably half of you haven't even heard of or don't know what it is. And, they have gathered momentum as a group and have exercised their power in the market against a certain subset of the players in the market, which we will call hedge funds. And so we are going to talk a little bit about this. And Lauren, I think if you could help us all kind of just understand the mechanics of what happened, and then we can, I intentionally wanted Jonathan and I and Lauren to just have a free-ranging discussion of whatever implications or conclusions we draw. I, of course, have my own point of view, but I want to say one thing, which I thought was interesting. I have these little curveballs to toss, which is, on Friday, the CEO of Robinhood, which is the free stock trading app, kind of at the center of this firefight, if you will, is a guy named Vlad Tenev. And he said on TV that never before has social media impacted the capital markets like they have now, which made me laugh because I had to look and notice that Vlad Tenev is 31 years old, and it made me, and I wanted to instantly award him the Alanis Morissette Isn't It Ironic Statement of the Day award. And then that forced me to look at when was Ironic by Alanis Morissette published, which happened to be 1995. I'm 50. I was born in 70. I was 25 when Ironic by Alanis Morissette was originally published. Of course, our friend Vlad was 4, so he probably doesn't remember that as well as I do. But anyway, that was a time when the Yahoo chat boards took a certain group of stocks at that point, internet incubators, which was Internet 1.0, up to the moon and beyond, when companies that we still own to this day, like Qualcomm and Cisco, were many times higher than they are today, even split adjusted and all the rest of it. So my own perspective is there's nothing new under the sun. This is just a new application of a problem that has gone on. They wrote about tulip mania, I think it was in the 1400s, and many manias since then. This happens to be the current one. Will it end well? Not in my opinion, but I will hold my judgment till the end. And I said to you guys unofficially, this is a scrum I prefer to stay out of, like a bar fight or any type of other brawl. Best witnessed from the sidelines, and I will be tiptoeing over here quietly to the side where I don't get hit by any random flying beer bottles. So having said that, Lauren, why don't you kind of describe what happened and how we got to this point, and we'll go from there.
Sure. So for those of you paying attention to headlines in the last week, there's a company called GameStop that a Reddit thread group called Wall Street Bets got behind and decided to essentially bid up. So if you can read as much about this as you want, I'll keep it super high level, but essentially they bid it up. Hedge funds had to cover some short positions. They figured out that a particular hedge fund in general had a 140% short position. So they essentially created a short squeeze, which is when the price goes up enough that people who are short the position have to cover their positions by buying the stock back, essentially making it run up even further. So GameStop was at what, $5? Today it's at $2.80. It got up to $3.50. Are those numbers right, Jonathan? But
got up to $4.80.
Got to $4.80.
Yeah.
So
you missed 100 points here and there. It can start to add up.
100 points. So the takeaway is retail investors on social media threads essentially manipulating market moves and resulting in potential bankruptcies of billions of dollars of institutional capital. So the calls that I've been getting have been asking some interesting questions, not so much, what is our opinion on all of this, but kind of educational questions like, why does short selling exist? And is this a new thing? Who came up with this? And just trying to understand the mechanics of the market. So I thought that was an interesting thing to talk to, which I can go into a little bit more. But Jonathan, why don't you give us, fill in what I've left out, and I'd love to hear your take on kind of what you think happens next.
Sure. So on the mechanics part as to what happened, I think there's 3 parts actually to the story of what happened, and they all sort of tie together. So the first part started with what is called a gamma squeeze. So these Wall Street bettors, they realized that if they buy enough call options on the stock, which is a bet that the stock will go up, somebody has to take the other side of that trade. So if the stock goes up, somebody has to pay them. Well, with nobody betting on the downside, the market makers themselves are holding the other side of that risk. But a market maker is not in the business to take risks and bet on stocks going up or down. They're in the business of transacting between a buyer and seller and taking a fee. But now they're forced to take a side of the bet. So what happens is if the price of the stock goes up, the market maker starts losing money. So what do? They go out and buy the stock itself to sort of balance out that position. So the call option is making money that they have to pay out, but the stock that they bought is also making money. It's hedged out. So that in turn, the Wall Street bettors are buying options to push market makers to buy shares, which pushes the price up, which pushes the price of options up, which makes market makers buy more. So that's one squeeze on the market that the Wall Street bettors had created. And that folds into the second squeeze, which is, you're right, there was 140% short shares in the market. So as the price of the stock goes up, the hedge funds that are short those stocks need to cover their positions. They need to buy back those stocks, which pushes the price even higher. So it's not only one squeeze, two squeezes. And the third part of the story is, when Robinhood decided to shut down trading, and now they're limiting to 2 trades a day for stocks like GameStop and AMC. So what exactly is going on there? And the way I can best easily explain it is that the clearing houses behind Robinhood and Goldman Sachs and E-Trade is like the casino cashier cage in a VIP high roller room, right? So if you imagine Robinhood and Goldman Sachs and E-Trade, all these platforms that you trade on as players in the casino, high roller players in the casino, we all know that in a casino, you bring your cash, you exchange for chips, you play, and at the end of the day, you exchange back for cash. But for high rollers who want to play $10 million every day, it's kind of hard to bring $10 million cash. So what the casino says, or what the clearinghouse says, is, hey, Robinhood, Goldman, you guys trade high volumes every day. No need to put the cash up front. If you deposit $1 million with me, I'll give you a $9 million line of credit. So you can play with $10 million. And the only caveat is you have to pay me your losings in 2 days. And if you win, I pay you out in 2 days, right? So no longer do the high rollers need to worry, oh, if I lose a hand, if I win a big hand, is that guy going to pay me? No, the casino is going to guarantee that they pay. Now, what happens in typical market environments, like if GME is at $20 a share, 25, 15, that's like the high rollers making $10,000, $20,000 bets at a time. It's rather small. They might win or lose $100,000, $200,000 a day, and that's fine because they'll pay in 2 days. They're good for the money, and even if they don't, they have $1 million in margin that they can cover, right? So the risk is not that bad. The problem becomes when GME starts trading at $500 a share. Suddenly, instead of betting $10,000, $20,000 a hand, these high rollers are betting $500,000, $1 million bets every single hand. In a case like that, you could easily lose $20, $30 million a night. So the casino suddenly steps back and they say, wait a minute, you only have a $1 million deposit, but you may or may not lose 30 million tonight. And I don't know if you're good for that much money, and I don't want to be on the risk for that much money. So all of a sudden, I want to announce that, hey, starting tomorrow, if you want to play at these high stakes with GME at $500, then you have to load in $10 million into your margin account. So for some of the bigger brokerages out there, that wasn't a problem. They were able to fill that easily. I think Fidelity didn't stop trading. But for a company like
Schwab didn't stop trading.
Oh, yeah. So for a company like Robinhood, who's sort of up and coming, maybe they didn't have that much capital behind, that's a lot of margin to come up with. So what resulted happening was they had to pull on lines of credit from JP Morgan, Goldman Sachs. They raised billions of dollars from Sequoia, and it just broke on Bloomberg that they're going to raise another $1 billion in debt because that margin is a lot of money for them.
They raised $1 billion on Friday, 2.4 billion in equity today, and more coming.
Right. So that's a lot of their bankroll that they have to put in margin at the cashier just to play in these high stakes games now. So Robinhood, to manage its own risk, because all its money is tied up in the cashier, they say, okay, we need to play smaller stakes. We can't be betting so many hands all the time. So they tell their clients, hey, you can only trade 2 stocks a day now. Instead of playing every single hand, you can only play 1 out of 5 hands, right? Or maybe you can't bet that big anymore. You need a bit less. And that's created some turmoil in the markets where people are saying, okay, why is Robinhood restricting people from trading? Did they get pressure from, somebody to stop their clients from being able to trade? When really, it is sort of a liquidity issue that comes with a company that maybe grew too fast and is going through some growing pains. So that's what we're seeing today. And I think the short squeeze is rather over. I think some reports came out that, last week short was at 140% of the shares, and today it's only at 23%.
Wow.
which means the move is probably over, and we're seeing that today when GME is down, 30%.
I think I wouldn't you agree with this? And I believe this is how this is going to get written in when we look back, which is, Melvin and Point 72 or whatever, several of the funds that were short GME got flattened in January on the way up. And then all the little guys that were buying one share of Robinhood for $450 on Friday or whatever, they're going to get flattened on the way down.
Mhm.
So, I mean, I think when this is all said and done, there will be a lot of losers and very few winners, except for
Mhm.
Citadel, right? Who's going to sit as, and again, the way you had the casino as the metaphor, I had the sports book as the metaphor, which is all that's happening now is they're blowing out, lines, and figuring out how they can price their risk on the interior because the house is always going to win. And so that's, I think, the difference between that speculation, which is, betting on coin flips of the Super Bowl as a prop bet. The house sets the odds where they're never going to lose those bets in aggregate. And what happened in this instance, in my mind, is that, no casino or sports book is prepared to come in when everybody is on the one side of the bet if the bet is being manipulated against them. You know what I mean? So it sort of got very artificial there for a little while, but then they blew out the spreads of all these options and everything. I showed this to you the other day. A put option on GME at 400 was trading at almost $90. So there's just like impossible to win on these bets when they get to these massive levels of volatility. So, as I said, we avoid, getting into a position where we can lose a lot on those type of things because that's not what we do. So, anyway, thank you for that.
Thank you,
discussion.
Jonathan. I love that analogy.
Yeah,
I think the only thing else I want to make sure we get across is this concept of short selling in terms of questions like, why don't we just make short selling illegal? So regulators have looked at this several times. Back in 2007, the SEC did an official ruling on it in 1935 to make it legal, but I looked and short selling actually started in the early 1800s. So it is not a new invention by hedge funds to manipulate markets in any sense. It was created as a way for people essentially to have more liquidity in the market and to have a check on valuations that may have run up. It's just it is a form of
and
speculation,
charlatans
I guess.
and bad actors that are running companies, right? I mean, Enron was
Yeah.
revealed and discovered by a short seller, and
Right.
a lot of different malfeasance gets investigated by people who are looking at that, which keeps the system in general.
It keeps
cleaner.
it honest. Yeah. And they're kind of, I think there's some questionable things that go into this, like the ability to be over 100% short with leverage. There's a lot of kind of complexities in the system now. But I think just essentially short selling provides essential liquidity to the market that helps retailer investors in that they can get out of positions when they need to in a way that they might not be able to if there weren't trillions of dollars in short positions. So Don or Jonathan, do you have any take on that?
Yeah, I'd hop in. I'd say, the CEO of Muddy Waters Capital, which is a famous short selling firm, was on Bloomberg actually like an hour ago, and he was saying how he's getting all these threats now. People are angry at him that he's part of the establishment trying to destroy companies and whatnot. When in reality, for so many years he's been the one trying to find fraud in the system, and he's actually the one against the establishment, but now he's viewed as it. There's nothing inherently wrong with short selling. I think in this case the problem was, and this goes to one of the implications of this whole thing, which is the greed that followed, and in what these short sellers in GME were trying to do. So they owe the market essentially 140% of the shares that are even in the market, which is incredible. So that just goes to show the limits that some of these hedge funds are willing to go to get that extra return. I mean, if you're in the 90s and you're a short seller, you can get about 6% in interest being short because you're holding cash and
Mhm.
you're collecting interest. Whereas today, when yields are at zero, as a short seller, you're not making any money during that process. So the only way to make money is to do what everybody else in the market is doing, and that's to go further and further out on the risk.
Mhm.
So for a short seller, that means shorting more and more and more stock until you get something like it was in GME, which was clearly bad risk management and probably a little greed and overconfidence. But yeah,
Yeah, and I would just say I have no sympathy for Melvin, and I have no misconceptions about he was, going to hold that stock until it hit zero and all
Mhm.
15,000 people were gone and laid
Mhm.
off. But I mean, I take a more fundamental view of this, which is all of business, all of life is a big survival of the fittest competition, right? And GameStop is in the fundamental business of selling, they were trading physical cartridges with one another, which in strip malls, largely in malls, which was a fine business 15 years ago. And like even my 15-year-old son said, I haven't been in a GameStop since I was 5, and it's
Mhm.
like that's so from a fundamental business perspective, did that business deserve, to have 15,000 employees, blah, 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 or get bailed out or whatever? It's like, but I have no sympathy for Melvin either. As somebody said it over the weekend, they are the apex predators of capitalism.
Mhm.
So if those guys shoot off their fingers, then the risk they're taking ultimately hurts the firefighters and pensioners that they manage money for, which is, you know, too bad in that sense. But it is how the system is designed. So I'm a believer in if you want to fix the rules of the system, fix the rules of the system. And should you be able to be synthetically short 140% of the float? No, that doesn't make any common
Mhm.
sense, right? But within the parameters of all the, the white hats and the black hats, they both are allowed to articulate their point of view in
Mhm.
capitalism. And then, the Elon Musks of the world will ultimately prove themselves right, which
Mhm.
is these are big markets, these are new technologies, these are businesses that work, and some of them don't. And I don't like the fact that some of them get bailed out. I'm not a
Yeah.
believer, but the people that work at those companies want them to get bailed out because they don't want to be out of jobs either. So it's just a complicated, you know, continuum, and it's a lot of gray in the middle.
yeah. Speaking of getting bailed out and stuff, I think that's one of the risks that was running with this whole situation was that could it spill over into the rest of the markets because hedge funds don't typically need to disclose, how much leverage they're operating with and what.
That's the problem.
Mhm.
Yeah,
Yeah.
so an example is in the 1990s, long-term capital management had $4 billion assets under management, but through margin and the options and derivatives they leveraged, they were able to
Mhm.
effectively command 1.4 trillion in capital, which is, the size of an entire continent, which is incredible. So when we look at these hedge funds that are short, we don't know what else is in their portfolio. And when they need to cover their short positions and they need to liquidate positions, what sort of implications that has. But it seems like today the shorts are covering, the market's doing well, so it seems like that risk probably isn't there for the time being.
Well, anyway, I think in the interest of time, shall we leave it
Yep.
there for this
Yep.
discussion? And if this continues to be an ongoing running theme, then we will address it again. But for the time being, it is on everyone's mind, so we wanted to chat about it. It's great to hear your guys' thoughts on it. Thank you for both coming out from slightly different perspectives. Appreciate that. Learned a little bit. And for everybody else, we're here. Here we are in February 2021, rounding nearly a year of pandemic life. But hopefully, as we've seen from the vaccine news, there's help on the way, there's good news on the way, and we are all, in front of each other in physical form here before you know it. But anyway, thanks everyone. We'll talk to you soon.